It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast as we tear into the Australian property market and pull it apart in our weekly analysis. How are you relating to the current property market conditions? And is there something that you would like to hear us cover more of? If you've got a suggestion, a thought, a nagging worry about the real estate, let us know. We are a family of listeners, and the more ideas to throw into the melting pot of ideas, the merrier. Or you might have a positive, uplifting property story that you would like to share with us. You can send us a voice message as always. The link to the voice message is below. Or email us, myrealestatepodcast@gmail.com. And here is a stark reality check. The great Australian dream isn't dead, but it's getting harder and harder to reach. Domain tells us this week that entry-level house repayments now swallow almost 49% of a young couple's income across the capitals. Units, wow, you look at the units, they ain't much better at just over swallowing 30% of incomes. Even with rate cuts and first home buyer schemes, affordability, can you believe it, has worsened. Prices are rising faster than wages, deposits are taking longer to save, and what used to be the stepping stone, and that is units, it is no longer the pressure valve that it once was. And we'll talk about that in just a moment. It is a Friday, just a couple of more days before we get into March, February the 27th. Coming up, we're also going to be talking about interest rate speculation, first home buyer incentives, and possible tax reforms in the May budget. So let's go to Sydney, where Anthony Landau, the Managing Director of Equilibria Finance, he is waiting for us. And good morning to you, Anthony. As I say, 49% of young couples' incomes across the capitals are being spent, and units aren't much better with 30%.
Yeah, good morning. Fantastic to be here. And your little summary of the Domain Housing Report was really spot on. I mean, 49% of your income is essentially half of what you're earning. The rule of thumb used to be around about 30%. That's where units are sitting now. But again, units are just about out of the market for a lot of home buyers now, with the median unit price in Sydney, for example, around about $900,000. So it's tough stuff out there trying to get onto the property market.
Extremely tough. And talking of tough, inflation numbers, they've just come out.
Yeah, look, inflation numbers came out this week for January, and the headline number stayed at 3.8%. The trim mean went up to 3.4%. Both those numbers sit well outside the RBA's target range of 2 to 3%. This just brings more talk around a potential rate rise. I think we'll wait for the March quarterly data before the RBA pulls the trigger. So it might be we're looking at a rate rise in May at their meeting then.
Yeah, and we're seeing renewed strength across regional Australia at the moment, particularly in lifestyle corridors within 2 to 3 hours of capital cities. Affordability gaps, which we continually talk about, hybrid work flexibility as well, infrastructure investment and population spillover from expensive metro markets are all driving demand. Limited housing supply, we talk about that all the time in many of these regional centres, is also amplifying price growth and tightening rental conditions. So the regional markets seem to be leading the charge this year in 2026. What is driving it from your end?
I think it's probably to the point we started with, all about affordability. The affordability pressures are driving people to those commutable areas, the regionals, areas people are now able to work from and come back to the city maybe 2 or 3 days a week. As you touched on, the regional markets have outperformed capital cities. Regional dwelling values up about 3.2% to January 26. The capital's 2.1%. And as I said, mainly affordability, internal migration, people moving out from the capital cities, creating more competition in the regionals, which is driving up prices. A couple of the stronger performing areas, for example, in New South Wales, Wagga's grown 8.1% in the 3 months to January. Western Australia region 6.1%. So some really, really strong growth in those regional markets.
Wow, 8% for Wagga in just 3 months. And yes, with deposit hurdles reduced, more of these first home buyers, they're entering the market sooner, particularly in these outer suburbs and regional hubs. Competition is strongest at entry-level price points where stock is already tight. Now, while these schemes improve access, they can also add upward pressure on prices when supply doesn't keep pace. How much of an uplift in first home buyer activity are you seeing there firsthand in Sydney?
A lot. First home buyer activity is at its highest level since March 2022. It's increased to close to 7% in the September to December quarter of 2025. We saw the first home loan deposit scheme, the eligibility criteria change in October 2025 with the removal of the income caps and the increased property price caps, and the Help to Buy scheme came out in late 25. So there's an absolute correlation with those programs and the increase in first home buyer activity. The other thing we're seeing is demand in those areas underneath those property price caps is absolutely surging. We've seen growth in the lower quartile suburbs, if you like, of 11% compared to in the upper quartile suburbs of 6.7%. And that directly relates to where first home buyers are trying to get into the market, creating increased demand, creating increase in housing values.
Yeah, and if you are a first home buyer and you're finding that struggle, exactly what Anthony is talking about, get on the email. Let us know. myrealestatepodcast@gmail.com. We are talking to Anthony Landau on the Saturday Property Show. When we come back this week, there has been plenty of talk about the capital gains tax. We'll talk about that after this.
Every morning from 6 a.m. across Australia, we deliver you the latest property news, commentary and predictions from Perth to Cairns and from Melbourne to Brisbane, 7 days a week.
Coming back to this Domain report out a couple of days ago, the struggle for buyers is no longer just a Sydney story. Yes, Sydney does remain the toughest market, with couples needing nearly 8 years to save a 20% deposit for an entry-level house. But Brisbane, Adelaide and Perth, they are catching up fast after huge price growths. If you look at the wages, they have risen 21% in 5 years. Entry-level houses up 68% nationally and more than 100% in some cities. That gap right there is the affordability crisis in one sentence. Which leads me back to Anthony, the capital gains tax policy discussions. Now, they have centred on possible adjustments, particularly the 50% discount for assets held longer than 12 months. While nothing is confirmed, reform conversations typically focus on reducing tax incentives that favour property investments over other asset classes. Now, the May budget, it is coming, Anthony. Perhaps just highlight the proposed changes for the listener.
Yeah, the Labor government's been circling around this for a number of years. In fact, it could be argued they lost the 2019 election based on some of their proposed changes to capital gains tax and at that time negative gearing. They're now just talking about capital gains tax. You might look at it one way and think that it's all about a revenue grab as much as actually solving housing. We'll come back to that later. But essentially, the change proposed is currently, if you own an investment property for more than 12 months, you only pay 50% of the capital gain upon the sale of the property. The proposed change is to halve that capital gains discount from 50% to 25% in simple terms.
Yeah, and any reduction in capital gains tax concessions could shift investor calculations around long-term capital growth strategies, and that can be a worry. Some investors may hold assets longer while others could pause those new purchases amid this whole uncertainty that you're talking about. If changes do occur, what impact could this have on investor behaviour? And just as importantly, we shouldn't forget about the rental market in all of this.
Yeah, absolutely. And there's a lot of talk around the potential impacts of this policy and potential unforeseen consequences. First thing I should say, it is likely that existing investor properties will be grandfathered. So the concession won't change for existing investors, of which there's 2.3 million mums and dad investors in Australia. It'll go forward with new investment properties. I think the main conversations around what impact will it have on new investors, firstly, coming into the market? Will it decrease the number of investors coming into the market where they shift their asset allocation to, say, shares? Secondly, will investor strategy change? Will investors, rather than try and build a portfolio and turn over stock, will they hold stock for longer? Potential impacts of that are less stock on the market if you've got less investors or less turnover. Less stock on the market potentially means an increase in rent for those people seeking to rent. The other thing that might happen in maybe a less clear way is potentially investors increasing rents to pass on the costs, because they'll be doing their cash flow analysis. They'll be looking at the overall picture of their investment portfolio and whether they increase the rents, we're trying to get a higher yield on the way through, knowing that the actual capital gain at the end is less. And the last point I'd make is it doesn't solve the main issue with Australian housing, which is this issue of supply. All this does is move the deck chairs around and potentially disincentivise mum and dad investors getting into the market and providing stock for renters. It does not resolve our chronic undersupply issue in the housing market.
Yeah, and with the inflation numbers that are out, all eyes, of course, are going to be with the RBA, and we say it every time, when that is coming up. What is likely to happen? Well, I think we know, don't we? Don't we know what is probably likely to happen with those inflation numbers that have been released?
Yeah, look, I think most economists, the markets, they've all priced in one or maybe two interest rate rises. The next meeting's in March. My instinct is that the RBA board will wait for the March quarterly inflation data to come out to see where that sits. So it might be that there's not an increase until the May board meeting. Fixed rates also are now, some of the fixed rates have a 6 in front of them, which is indicating at least one or even two more rate rises are on the radar. That's the direction we're heading. It's probably more about when they actually implement the next increase.
As far as those fixed rates are concerned, towards the end of last year, I got into a conversation talking to somebody, and I was saying, look, you probably should be sort of prudent here. Maybe look at the fixing of your mortgage. The comment was made, oh no, the interest rates, they're going to come down now. And see, it's been proven. If you had have got in there and fixed it, you'd probably give yourself some cover. But hey, that's all hindsight 2020. Great stuff, Anthony. Enjoy your Friday, the weekend coming up. Look forward to catching you back in a couple of weeks' time.
Yeah, great to be here, and enjoy your weekends, everybody.
Every morning from 6 a.m, we bring you the latest real estate news with diverse perspectives from leading industry experts. We deliver the most property podcasts across Australia every week.
Fully assessed pre-approval, especially for first-home buyers. This is very, very important because there are two types of pre-approvals, aren't there?
Yes, that's right, Craig. There is the system-generated pre-approval, which essentially is just an application submitted, but it just runs through some very basic checks like credit checks. Whereas you've got the fully assessed pre-approval, which is essentially a full application. When you're buying at auction, it's obviously unconditional, so you don't want to be in the position where your documentation and your income hasn't been fully assessed, because it may result in a decline when you go to convert it to formal approval.
Have you kind of inherited some of these people that have done that?
Absolutely. I have had people come to me in this situation and they are very stressed. So I usually can find them a solution, but some people are really stuck if they only really had one or two lenders that they qualify with.
We connect you to the best real estate information across Australia. The Real Estate Podcast.